It is not only in France that the summer looks gray. On the other side of the Atlantic, in San Jose in California, the land of Silicon Valley, the barometers are going crazy. Big dark clouds also threaten the Seattle Silicon Forest, home to Amazon and Microsoft, the Silicon Hills of Austin and Texas, and they accumulate all along the famous Route 128 that goes around Boston, one of the largest research centers on artificial intelligence. After years of sunny growth on a clear sky, a cold bottom has come to fall on the tech sector. While it jumped by 93% between its low in October 2022 and its high on July 14th last year, the Nasdaq 100, composed of the largest U.S. non-financial companies and largely dominated by technology stocks, fell by almost 9% in 2 weeks. He brings with him Asian and European values. What contrary wind could have capsized such a huge ship and launched at full speed on a sea that we thought was oil? Observers are scanning the sky in search of signals that could inform them about the violence of the storm that is beginning. Will it cause the S&P 500 to collapse by 70%, as the Husman Investment Trust has predicted? What does Michael Burry, the big short man of 2008, who recently got rid of his Amazon, Google, or Oracle shares, fear? And what about Warren Buffett, the Oracle of Omaha, who has parted with half of his Apple titles since the beginning of the year? Is it possible that it is only a passing downpour? And if not, how to deal with what, according to the most pessimistic, is already happening? The mother of stock market bubbles, the correction 100 times announced and always postponed. Let's go for a little tour of the tech markets in the middle of summer. Enough to give yourself a few handy cold sweats and a heat wave. Welcome to Money Vision. Crash notice. Fasten your seatbelts, raise your tablets. We are going to cross a rather intense turbulence zone. After 21 months of almost uninterrupted growth, tech is turning around. During this period, the Magnificent S have become the favorites of all markets, and their performance has exploded. Plus 67% for Tesla, almost as much for Apple, plus 87% for Microsoft, plus 138% for Amazon and Meta, and plus 175% for Nvidia, the giant of the computer accelerator. Nvidia even rose for a while to the largest capitalization in the world, ahead of the unbeatable Apple. But the party is over. Since July 14th, the whole world has suddenly frozen and the holders of technological stocks are taking a cold shower. At the top of the most beautiful bowls, those that rose the fastest and the highest in 2 weeks, Nvidia lost 22%, Meta 14%, Tesla 18%, Microsoft, Google and Amazon declined by about 10%. The Invesco QQQ Specialized Tracker, the fifth best-selling ETF in the world, almost $250 billion in progress, jumped by 90% before falling by 8.5%. The high-Shar semiconductors declined by 15.8% after a good climb of 162% over the same period. The most resistant asset is Apple, Warren Buffett's favorite stock, which has not stolen its anti-fragile stock label and which is down only 7.5%. Finally, the Nasdaq 100, composed of 60% technology, declined by almost 9%, while the Dow Jones is down only 1.5% and the S&P 500 by 4.3%. What happened? What happened? The situation can be summarized in 2 words: margin and software. The market's doubt in the face of figures that give a whirl. Investors are getting impatient and are starting to worry that AI will ultimately not be as profitable as that. In a report from Goldman Sachs dated June 1st, we mentioned the increase in personnel costs, the manufacturing costs of electronic components, and a future very significant increase in research and development expenses, $500 billion for 2024 in the United States alone. On the other hand, we should expect to have lowered the insolent margin rates to which Nvidia, Microsoft, Dell, Marvell, or even Ultra Computer have accustomed us, while their shares are greatly overvalued by the markets. Nvidia is a textbook case. She's been in the headlines since last summer. The giant has solid fundamentals, moderate debt, and despite mixed results in 2023, it has given very good prospects for 2024 and until 2030. But the markets became passionate about it after the lockdowns and carried it so high that it was necessary to divide the share price by 10 at the beginning of June and August last year. While it was trailing Apple in the ranking of the largest companies on the Nasdaq, Nvidia posted a PER of more than 115 points, which clearly expressed the enormous enthusiasm of investors for some or their furious madness for others. A PER of 115 indicates that investors agree to now pay 115 times every dollar of future profit. Delusions? No, at the beginning of August it dropped back to 65, but it is still very high. In the sector, the average PE is rather around 20 points, and this is a chasm that separates Nvidia from its competitors. Concretely, this may especially indicate that the fall is not over, while knowing that Nvidia is also exposed to the same geopolitical risks or disruption of supply chains as the rest of the sector. Finally, rumors are already running about possible delays in the delivery of its new chips, which could penalize its largest customers such as Microsoft and Google. It has already started with the rout of software publishers since the end of May. Markets are reducing their exposure to the software sector. Several stocks have melted down, such as Salesforce and the specialized growth fund of Goldman Sachs. The general feeling has deteriorated so much that even companies that show good results like CrowdStrike and ServiceNow are penalized. At the origin of the sudden disenchantment, the growth of sales which slowed down in 2023, a movement felt by Auth0 and other publishers. In a context of high rates, problems of access to financing with the fear that AI will divert the bulk of investments. For experts, this is a sign that the markets were not mistaken. The market is turning around and the fall is going to be severe. And by searching a little, we find other clues. Portfolio movements at Wales, for example, Sand Capital or Berkshire Hathaway at Warren Buffett. Apple has held a class of choice for about 10 years. It is a safe bet known for its anti-fragility, and which for a time represented almost half of the assets of the American fund. But since January 1st, Berkshire has shrunk its sales and parted with 55% of its securities, or 505 million shares, and in passing, it has achieved 800% capital gain. And what worries the markets is that observers know that between the slowdown in Apple's growth and its current high valuation, the Wall Street giant now places itself outside the Berkshire criteria. About 10 years ago, when Warren started accumulating Apple shares, $1 of future profit was paid for about $16, and today it takes 34, an increase unrelated to the results of the firm according to Warren's principles. But the explanation is rather to be sought from the side of the situation of public finances in the United States. Warren fears that the fiscal slippage will lead Washington to raise new taxes on capital gains, and the early sale of part of the securities will make it possible to escape it. As for Mike Burry, he simply liquidated 15% of his portfolio in technology stocks, Amazon, Oracle, and Alphabet stocks. Mike explained himself on X, his favorite network, and he confirmed the general feeling. According to him, tech stocks are much too expensive and there are more opportunities elsewhere, such as in China, for example. But the two geniuses leave us a little glimmer of hope. They are not particularly pessimistic, and I will come back to that. The pessimist of history. Rather, it is he, John Hussman, an American billionaire, CEO of the Hussman Investment Trust, and who has already provided several terrible forecasts in the past. And here is the apocalypse according to St. John. From July 14, 2024, we should expect a gradual decline in the S&P 500 and the Nasdaq by almost 70%. It is difficult to assess how much all the companies in the S&P 500 weigh, but no need, we already know that it is a lot of money. And yet, he does not take his prediction out of a hat. John compared the market capitalization of non-financial companies with their turnover, and the result has never been higher, not before the crisis of 1929, not before the dot-com explosion in 2001, or even before the subprime crisis. He bluntly predicts the imminent ruin of the entire American economy, and in turn, that of all the others. What's going to happen now? Don't panic. Not all observers agree with John Hussman's predictions of the end of the world, and above all, they are not fixed. If a moment of weakness or a frank correction of the tech mega-cap are possible, nothing says that they will lead to a global collapse of Wall Street and all European or Asian technology stocks. The opportunities linked to the development of AI go far beyond these fantasies and will improve productivity in many other sectors such as health, industry, or finance. Everything can end with a simple change of orientation, a rotation of the markets towards other values, including other technologies or the smallest capitalizations, including the most profitable ones. And after the correction, of course, this is also the feeling of Michael Burry. As for Warren, he once again expressed his love for Apple last May during the Berkshire General Meeting. He showered it with praise and called it an even better company. However, he knows that his AI strategy will not bring much to his growth, and he does not rule out selling the rest of his titles. Everything will now depend on two main parameters: rates and results. The rates. Maintained at 5.5% for the past year, they weigh heavily on debt, profitability, and the amount of investments in research and development. On July 31st, all eyes once again turned to the Fed, which maintained the 5.5%. Powell's cautious speech, however, reassured the markets. Inflation is now approaching its 2% target. The unemployment rate is flirting with 4.3%, but against all recession forecasts, America recorded growth of 2.8% in the second quarter. This is almost a third more than the experts expected. Faced with the economic figures, the markets are demanding a more frank cut in key interest rates than the 0.25% mentioned for the start of the new school year. If the Fed decides to meet demand, the worst could be avoided. The results. The second element capable of canceling the end of the world for John Hussman is the results. In the Hussman equation, there are two directions. If the results are good, companies can somehow make up the gap between the share price and its real performance. In this case, the indicator drops. Conversely, if the results are bad, then the markets will have to adjust abruptly until they reach an equilibrium value. This is what happened in 2000. That year, John had already calculated a decline of 83%. It also happened in 2007, when the S&P 500 lost more than half of its value, exceeding the pessimistic forecasts of John, who announced only 40% less. Yes, it can be scary, but John has already made a mistake, and most importantly, he does not write the future. At the time when I am preparing this video, all the results have not yet fallen, but the first performances have arrived and are generally superior to the forecasts. Compared to the second quarter of last year, Microsoft sees its activities jump by 10% and its net income by 15% to reach $22 billion. Google also reassures with 14% more revenue and $23.6 billion in profit, which is 28% more than a year ago. AMD surprised everyone. The Nvidia competitor presents a revenue higher by 26% than that of the Q2 of 2023, $6.7 billion, and higher than the forecasts by 22%. But these benefits do not impress Wall Street, which no longer wants promises, but returns in the face of current economic uncertainties and political threats. One of yours is better than two, you will have it. In reality, the year 2024 will present itself as a pivotal year for tech and growth markets. Investors are now waiting for evidence. They want to know that artificial intelligence, at the origin of the fourth industrial revolution, which is already called the philosopher's stone of the 21st century, will first benefit them who have bet their money, and especially quickly. I'm barely schematizing. The future is therefore absolutely not fixed, and the bad slope on which the whole sector is sliding could still change direction if the tech keeps all its promises. It must now prove that it is capable of this before next Christmas, that the Fed's winds are favorable to it. And what do we do now? When you are an investor who has bet your savings on the growth values of the Nasdaq or on those of the stock's Tech 600, what should you do? Should we sell while there is still time? Should we keep and bend our backs while waiting for better days? Is it still wise to buy tech with the current risks? I remind you of some widespread principles. First, the smart investor buys when it goes down and sells when it goes up. This advice is offered to you by Warren Buffett, who does not sponsor us. If we follow this principle, it's time to take advantage of the decline in the stock market to buy securities taking advantage of nice discounts. But we don't buy just anything. Niches, rare pearls. It's taking a while, especially right now. These companies display solid fundamentals and real growth prospects, which are based on exclusive know-how and, if possible, at reasonable prices. If you already own technology stocks, don't panic either. It's always tempting to sell down stocks before it's too late, but the short-term visibility is too bad, and above all, never act urgently. If you are one of the lucky ones who bought growth stocks 4 or 5 years ago, normally, you have already realized a nice capital gain. But it's more complicated for those who have bought more recently. The custom then is to keep the stocks as long as possible while waiting for the next rebound, especially if the fundamentals are green. Obviously, it can take a while. That's why the scholarship is only considered for long terms. It takes 8 to 10 years for it to give everything it has. It then offers performances that no other asset has ever surpassed. Be patient. Leave speculation and misdemeanors to fans of great thrills who can afford to lose 10 times their starting bet. Investing with a distant horizon makes you insensitive to the significant price variations that shake and that will still shake one of the riskiest, the most immature but also the most promising sectors in the world. Finally, always remember to diversify your portfolio well and count on us to follow the news and relay the most important statistics on this subject.